Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be learning about how accounting treatments for depreciation is charged when it comes to depreciation accountancy. Now, when we've already learned that depreciation is nothing but reduction in the value of asset, a gradual continuous process whereby the asset value goes on shrinkage, or probably it keeps on shrinkaging every time every accounting year passes through, and this happens only until the useful life of any specific asset. We have also learned how these details are supposed to happen. Now let's go further and check how accounting treatments are supposed to be done here. So when we speak about reducing the value of the asset, it is nothing but reducing the actual value, or probably the book value of the asset, which will give you the net book asset, or probably the net book value of the asset. Now, when we do this, that means we are reducing the value of the asset every year, just to make sure that we have true and financial picture of any business concern. This is to make sure that all these details which are being provided to our users are absolutely fair and flawless. So let's study ahead and let's get to know how any accounting depreciation has an effect on terms of balance sheet or any financial account statements, which can be either profit and loss account or the balance sheet that we provide to our end users. We'll have certain entries which will necessary, or probably which will make necessary for you to learn, which is very simple. Just we'll have two entries here, one that is purchase of asset at the start of the year, and the next which will be the sale of the asset, or probably the depreciation of the asset as the condition is required. So if the sum says there is a sale of the asset, we'll have to record that entry, or probably if there is no sale, you just have to record the depreciation entries and the transfer of depreciation that we do every year. Now when we transfer the depreciation, we'll be moving this to profit and loss account. Hence, whenever we have asset accounts and whenever there is a depreciation, which is a non-cash expenditure, that will go to profit and loss account. Let's study, or let's probably go ahead and see what are those entries and what are we talking about. Now, charging depreciation to asset. This is the topic that we are going to learn about. Before doing that, we need to purchase that specific asset that we're talking about. Now here, when we talk about purchase of asset, that is completely related to purchase of fixed asset, which is going to be used for more than 1 year. Because anything that relates to current asset, that falls under the category of usage less than 12 months, which doesn't come under the purview of depreciation. Hence, when we talk about giving out any depreciation, that has to be charged only on the fixed asset. So the first point that we'll be doing through is purchase of fixed asset. We'll pass a specific entry for this. After that, we'll be going ahead and charging depreciation. Just a point to remember, in a year, you can purchase n number of assets. So it is not necessary that in a specific sum, you'll have just about one specific asset. A company might purchase 2 or 3 assets in one specific year, in one specific month, or in continuous months. So to make sure, you need to number those assets, how many numbers have been purchased or how many assets have been purchased at any specific date. You have to number them down so that it will be easy for you to recollect while giving out depreciations, because depreciation will differ on each and every asset. However, it might be same on any of these assets as well. So it completely depends on the kind of question you're dealing with. Now, let's go ahead and find out the steps that we have to go through. Purchase of asset. This basically refers to giving out depreciation. Hence, when we require any asset, that is a core integral part of charging depreciation and also as a part of production. Hence, purchase of asset is the most important category when it comes to charging depreciation. Now, asset can be either purchased on cash or credit basis. If it is purchased on cash, you need to give out cash. If it is on credit, you need to either mention whether it's on credit or probably the supplier that is being given to. So, when you're purchasing asset, if you remember, there's an increase in the asset value. Hence, we will debit, or probably you go ahead and debit the asset account, and if it is given out in cash, cash is being credited, or if the supplier is giving it on credit, the supplier's name will be credited. We'll be going through the entries in couple of times. Now, after this step, there will be charging of depreciation. Let's go ahead and find out what two steps have been mentioned here. End of year depreciation charge. Now, depreciation, as you know, has been always calculated at the end of every financial year or end of every accounting year. Hence, every depreciation that will be charged at the end of financial year will have a specific entry that you need to make sure, or probably that you need to understand whether it comes either at the end of December, which is one accounting year from Jan to December, or it comes in the end of April, which is again the other accounting year from April to March. So if the question states December, you need to calculate according to Jan to December. However, if there is an April to March accounting year, you need to calculate from April to March. Another point to remember here, you need to calculate depreciation from the time it has been bought, not necessarily if the accounting year is state from April to March, and if the asset has been purchased from June, you do not calculate depreciation from April. You can calculate from the month it has been bought. That means from June to March. The same thing applies for Jan to December. Any month the asset has been procured, you need to go ahead and figure out that thing, and from that date for that specific year itself, from the purchase year, you need to type it, or probably you need to go ahead and find out the depreciation from the year of purchase or from the month of purchase. Make sure you remember this thing, because this will be the most common mistake all of you students will be doing in case if any of these questions terminologies are missed out. Now, after charging depreciation, you need to show that thing in a balance sheet. That will be your third most important step, whereby you will be transferring the balance of the asset and of the depreciation to the balance sheet. One will be on the liability side and the second will be on the asset side. Hence, to make sure asset will be shown on the asset side and depreciation, as it is a provision, we need to show it on the liability side. Let's further find out what are the third step, or what are the three steps that we need to hire, or probably go ahead and find out when it comes to provision of depreciation or charging depreciation to asset. Now, as we have highlighted certain things here, balance sheet treatment, that's the topic name. Balance sheet treatment means how asset is shown in that specific balance sheet. Either it's on the net realizable value, or either it's on the original cost. If it is on the original cost, where is depreciation being shown? If it is on the net realizable value, on which side or probably which state of the balance sheet will you find that specific depreciation? Now, the points to remember here are two things. One, if the depreciation is shown as a liability, you will show it on the liability side. However, if you are showing the asset on the net realizable value, that means you are deducting that much of depreciation from the asset. Hence, that specific depreciation will be shown on the asset side, but as a subtraction or probably as a negative value. I'll give you more details on this when we go ahead further with the examples in this video itself. Let's find out what are the other details that you need to understand when it comes to charging depreciation. Provision for depreciation or accumulated depreciation. This is one of the most important topic when it comes to charging depreciation. In the first video, probably the first slide, you saw that how depreciation can be charged only when there is no provision there. However, if you are making provision, that means you need to further go ahead and keep the asset on the original cost value itself, and there should be no changes in the asset value. However, the real picture will always show that there is a difference between the asset value and the depreciation that has been charged. So if you can see one side of the balance sheet, that means the asset side, and the liability side will show two different things. Asset side will have the asset value, and the liability side will have the provision for depreciation that has been created every year until the sale of its day, or probably when the accumulated life or the useful life of the asset goes down. Hence, when you need to understand that there is any kind of specification that has been mentioned in here, you need to go through the sum very well, and you need to prepare down the gist what has been given in the sum. It starts from the date of the transaction when the asset was purchased, the time which is being asked while calculating depreciation, the sale of the asset, whether there is a partial or a complete sale, whether they're asking you the charge of method, probably being provision or a direct flat out depreciation, and the method of depreciation that is being used. We have learned about two methods, the straight line method and the WDV or reducing balance method. You need to make sure all these points are completely filled in before starting any question, because if you miss out any of these details, I'm pretty sure the sum will have a different answer as compared to the original ones. So provide utmost importance, or probably a lot of importance there when it comes to finding out these details. Now, as we have already started with provision for depreciation, we'll further go ahead and see what kind of details are made available in this kind of category. Here, asset appears at original cost. When we talk about assets always appear on original cost when you're following provision for depreciation method. So when we talk about provision for depreciation, it will be more of the asset being shown at the original cost value. There is a reason why we use this specific method, or why companies prefer provision for depreciation. If you see, asset side of the company shows the financial structure of how the good the company will be, or probably how good the company is when it comes to investment from suppliers, from lenders, from any creditors. So the asset side should be strong. However, if you're just showing the asset side to be strong and the depreciation amount is not charged, that's a false picture that will be giving out to our users. Hence, the asset side will be showing the original cost of the asset. However, if you see keenly on the liability side, there will be a tag which will say provision for depreciation on it. Now, when we further go ahead with this, if at all there is no provision for depreciation, that means you will see the asset at the net book value, or probably the net realizable value at the end of every year. That means every asset that you have will have deduction of depreciation in it. Once that has been done, or probably once that has been prepared, you need not figure out which side of the asset or which side of the balance sheet you need to further look into. If provision for depreciation has been provided, it will go on the liability side, and if there is a direct flat out depreciation deduction, it will further go on the asset side itself as a deduction from the asset. Keep in mind, or probably understand, these two things are very important when it comes to the charging method or the basis of charging depreciation, either in SLM method or in WDV method. That's the first thing that you need to understand when it comes to provision for depreciation. Let's go ahead and figure out what is the second thing that you need to understand when it comes to provision for depreciation. Depreciation accumulates in a separate account. Yes, when it comes to provision for depreciation, the specific depreciation goes ahead and it gets accumulated in a different account. Why? Is because we want to show our assets on the original cost value. Let's take an example. Mrs. ABC is a company which deals into garment clothing, and now they have the specific asset which is used for production of these garments. If you remember, we have already discussed that these assets are basically used for the financial purpose or for the business transactions itself. So when we talk about preparing these assets, we need to make sure that these transactions or these things are completely business transactions when it comes to recording the transactions in form of journal entries, ledger, trial balance, or any other mode of communication that we have when it comes to accountancy. Hence, when we talk about provision for depreciation, we show the assets on the original cost. That's the reason we have the depreciation being accumulated in a different account rather than deducting that same depreciation every year from the asset's value and reducing the value of the asset, which will further make sure that the asset side of the balance sheet is completely strong as compared to the liability side. Now, let's go ahead and check what are the points do we have when it comes to provision of depreciation here. I've marked 4 important steps when it comes to accounting treatment for depreciation. The first thing that you need to make sure is you record the purchase entry of the asset. The second thing that you need to make sure is that you record the depreciation of the asset. That means charging depreciation to the asset account. Third thing, before closing the books of accounts, you need to make sure that this specific depreciation which has been charged to the asset is transferred to profit and loss account. Hence, when we talk about charging depreciation, these three steps are very important. First, recording the purchase of the asset and maintaining the dates when it has been purchased. Second, charging the depreciation according to the method that has been used. It can be either SLM, it can be either WDV method, and using whether the question has asked you for provision for depreciation or the direct flat out method. If either of these things are missed out, the answer will go wrong and that will be a complete loss on your side. So make sure all these things are completely in order and follow that in order itself. Just make a gist that will help you in solving the sum with ease and there will be no problem in getting the answers right. Now, the third step, after all these things have been mentioned, you need to go ahead and put this thing in the balance sheet. So when you put this thing in the balance sheet, it is either the liability side that is affected or the asset side that has a net effect. If there is a provision of depreciation account, will be happen or will have a situation where probably the liability side, so the liability side will have total of the provision for depreciation which has been created and the asset side will have the original cost. But if there is no provision for depreciation, you will simply subtract depreciation from the asset side and that will give you the final value of the asset at the end of that specific year. So this is how the treatment for accounting depreciation has been done, or you need to record these transactions according to this way. Let's further go ahead and see what happens when you sell off these assets. Now, when you talk about disposal of assets, you need to make sure that either there is a complete disposal which has been recorded into the books of accounts, or if it is a partial disposal. Disposal means sale of asset. So if there is a complete disposal of asset, that means the complete asset has been wiped off the balance sheet. If there's a partial disposal, that means a part of that asset has been sold out. Now, there are certain queries that has been raised earlier in this topic when it comes to partial disposal. How can we have an asset be segregated into parts and sold out? Now, when the question comes like this, you need to make sure, or probably you can understand, there are certain assets which can be dismantled and can be sold out further. There are certain assets which work on the dependency of other assets as well. So if that specific asset which is working on the specifications or the dependency of some other asset, that means there is a possibility where the chances or probably the disposal of asset can happen if one of the asset becomes obsolete or if the asset is not in working condition. Hence, we either replace that part or we either replace a partial asset here and get a new one in that place. Hence, this specific thing, when I talk about complete or partial disposal, this is the difference that you need to understand. So when we talk about sale of asset, we'll either have a complete disposal or we'll either have a partial disposal here. After this thing, you need to record the transaction entries. So as you have recorded purchase transaction, similarly, when there is a sale of asset, you will record sale transaction here. Once this specific thing is done, you need to adjust the depreciation asset or probably the depreciation on any assets that has been charged here. Hence, you need to make sure if the provision for depreciation is there, before selling of the asset, the depreciation or the provision for depreciation is charged to the account. Only after that you can go ahead and sell off the asset, which will further evaluate whether you have earned profit on that specific asset or a loss. I'll be giving out certain situations to you which will clarify how an asset is procured, how the depreciation is charged, and how further we'll be going through when it comes to sale of asset. Let's create a situation for you which will help you clarify better way how a disposal is done and how a procurement is done for the assets. Let's go ahead and find that out for you. We have mentioned a situation here where Mrs. ABC procures an asset in the month of October 2018. I have assumed that the financial year starts from April, hence it will end in the March month. So this is just my assumption. It might happen that the question will state you what are the details that have been available. If no details available, you can put it as an assumption and you can continue further with the sum. However, if there is any month that has been prescribed that this depreciation is charged in the year or probably the month which has been prescribed, you need to follow that specific month itself. So let's get back to the situation. Mrs. ABC has procured an asset in the month of October 2018. Now, this specific asset will go from the depreciation charge. At the end of every financial year, for this question will have March 2019, we have provided depreciation for it. The star mark thing will give you clear idea about how the asset is purchased, how the depreciation is charged, and at the end of every financial year, there is a specific balance sheet that is prepared which will have the value of the asset, either whether it's charged on the depreciation mode, that is a flat out mode, or if there is a provision for depreciation. In any of these conditions, you need to make sure that the asset has the true value of it, that is the net realizable value. You can either subtract it or you can either have a provision for depreciation account in it. Now, there's a note that has been mentioned on the right hand side of the page. Just look at it. Will be continued until sale of asset. Now this process that we have followed, procurement of asset, charging depreciation, and then showing it in the balance sheet. Out of these three steps, the last two steps, that means charging depreciation and showing the value in the balance sheet, will continue every year until there comes a time when you have to sell out that asset or if the asset becomes obsolete. However, the first entry will be recorded only in the year of purchase because you don't purchase that same asset every year. Hence, once you record the purchase transaction, the next two transactions, that means charging depreciation and further showing that value in the balance sheet, will be done at the end of every financial year. If the useful life of the asset is 10 years, this thing will continue for 10 years. If before these 10 years are supposed to get completed, you have any situation where the asset becomes obsolete or non-functional, you go ahead and sell out that specific asset, and at that point of time, the transaction entries will stop and you will have the sale or disposal of asset entry. Now let's go ahead and find out how to pass the journal entries for these specific transactions, and after that we'll be going through few certain sums which will give you clarity on how to pass journal entries, how to prepare the accounts, and how to show them in the profit and loss and balance sheet statements. Let's go ahead and find out the journal entries part first. The first transaction that we'll be passing through is purchase of asset. So whenever there is any asset that has been purchased, you need to pass on this specific journal entry here. Now the journal entry for building up asset or probably procurement of asset is something that you need to remember first. If you remember, we had studied about the 5 kind of accounts that we have: assets, liabilities, capital, expenses and loss, revenue and gains. These are the kind of categories that we have when it comes to accountancy. Now asset being a specific thing that has been used for production of goods, that means we have an income flow here. Now if you're building up assets, that means if you're procuring asset always has a debit balance. That means the debit side will be increasing, and if you're selling off asset, the credit side will be on the decreasing side. So it's one simple thing. If you're procuring assets, asset accounts will be debited. Let's go ahead and find out if you're procuring this on cash or if you're procuring this on credit, how the entry will come. So if you can see, we have mentioned one specific entry here, purchase of asset. That means asset account debit to cash account or asset account debit to the vendor account. If the transaction has happened in terms of cash monetary value, that means you have to pass on an entry where asset account is credited because that is going out, real account. If you remember, we have always studied personal real and capital accounts, or personal real and nominal accounts, as the three golden accounting rules that you need to follow when you have to pass journal entries. After this, if at all there is a credit transaction here, that means the part of the asset or the asset procurement has happened on the basis of credit, which will be paid after some years, or probably if you're going into EMIs. So you need to go ahead and mention the name of the vendor who has provided you this asset. So asset account debit to the vendor account. This will be the entry. There will be a situation where either the asset is purchased in complete cash or in complete credit. However, there might also be a situation where the asset is procured in partial cash and partial credit. At that point of time, you need to pass both these entries. That means a combined entry whereby asset account will be debited to bank account to the vendor account. The amount which has been paid in cash as an advance can be credited to the bank account, and the amount where the vendor will be paid off after some time, or probably in terms of EMIs, will be credited under the name of the vendor. Hence, he forms as a sundry creditor here. Once this entry is passed, you further go ahead and charge depreciation. We'll now understand how charging depreciation is done and how the entry is passed on the assets. Now, the second entry or the second step that you need to follow is charging of depreciation. Here we'll have two steps. First, how the depreciation is charged. The second, how this depreciation is moved to the profit and loss account. If you see, depreciation is a non-cash expense. Still, it is an expense. Hence, we need to record this under profit and loss account category. We'll further go ahead and see how this specific asset or this specific transactions will have an effect on the balance sheet. Let's go ahead and find that thing out. The first thing or the first entry that we'll be looking after is charging of depreciation. Hence, the entry that will be charged, or probably that will be mentioned when it comes to charging depreciation, will be depreciation account debit to asset account. Now, this specific depreciation is a reduction in the value of asset. Hence, if you remember, asset procured, debit side increases, asset sold out, or if there's a reduction, credit side decreases. Hence, if there's a procurement, you will debit the asset account. However, if there is a reduction, you will always credit the asset account. Now, following this principle itself, depreciation account debit to specific asset account that has been used. That will be the first entry. Once this entry has been charged, you will further go ahead and transfer this depreciation to profit and loss account. Now, when you're transferring any of these expenses, remember, when there is expense or when there is income, there are two different categories that you'll follow, or you'll follow these two things when it comes to specifying journal entries. If expense has been mentioned in the question, profit and loss account will be debited. If there is an income mentioned in the question, profit and loss account will be credited. Follow this simple rule and you'll have all your journal entries in a jiffy. Now, here depreciation is an expense. Hence, when you're transferring depreciation, you will have profit and loss account to depreciation account as the closing entry at the end of every financial year. This entry will give you a conclusion. That means depreciation has been transferred to profit and loss account, and the same can be now shown in liabilities either as a deduction from the asset side or as a deduction from the liability side itself. So we'll figure out how a balance sheet is prepared with these effects. Now, after doing this, I'll have to show you certain things when it comes to settling of accounts. Look keenly on the star mark, the green star which has been done. Depreciation was first debited, and in the second entry, depreciation is credited with a similar amount. Of course, the depreciation that has been charged will be shown in the profit and loss account. But if you see, depreciation was debited first and the similar amount has been credited here. That means the account is settled. So this specific account gets settled at the time of passing these entries itself. You don't have to further evaluate how to settle these balances or how to settle these accounts. So this is one specific thing that you need to understand when it comes to charging depreciation. Now let's go ahead and figure out how a balance sheet will have effect of these specific transactions. If you see, I have mentioned certain things in this specific sheet. There is a format that has been prepared of the balance sheet. One side will have liability, the other side will have asset. If the first method is used, whereby there is a straight flat out deduction from the asset, this is what you will be doing. Asset value will be mentioned on the cost that has been procured with, and there will be a subtraction of depreciation from it. Now supposingly, if asset has a value of 10 lakhs and the depreciation per year is 50,000, that means out of 10 lakh you will subtract 50,000. The balance 9,50,000 will be the net value or the net book value of that specific asset, which will be shown on the asset side. However, if you are using the second method, whereby there is a provision for depreciation that has been created, now in that case asset value will remain the same. I'm showing you a different asset account here. This asset will have the original cost itself, only in case if you're using provision for depreciation. Hence, if asset is on the same value, that means on the original cost itself, that means on the other side, that is on the liability side, you'll have a provision for depreciation tab, under which the depreciation which has been accumulated over the years will be shown with the balance of it. So if you have any such details available here, you will have either the provision or a direct flat out straight out method whereby depreciation will be subtracted from the asset side. Now let's go ahead and understand how all these transactions or how all these methods can be used in one specific sum. I'll write down a sum for you, note down that question, and we'll further go ahead and evaluate that specific sum with all these formatting details. Now the question states that Messrs XYZ purchased an asset worth rupees 10 lakhs on 1st April 2018. Now there's a depreciation that is provided under SLM method. We'll assume that it's 10%. Now when this depreciation rate and the method has been provided, they have asked you to prepare journal entries for the next 3 years when it comes to providing depreciation and the accumulated amount that you'll have in terms of depreciation accounting. Now I've mentioned accumulated because I want to show you how depreciation can be charged with both these methods, or probably if the provision has been created, or if there is any situation, or if there is a direct deduction from any of these asset value. Let's go ahead and pass out the journal entries first, but before doing that we'll create a gist of what we have in the question. So we'll write down certain things that will make you easy when it comes to solving these kinds of word problems. Now the gist has been mentioned here, cost of asset rupees 10 lakh. The procurement of asset, that means the date when the asset was purchased, was 1st of April 2018. However, the depreciation that has to be provided is under SLM method at the rate of 10% and has to be calculated with the accumulated depreciation for next 3 years. Let's go ahead and find out what are the entries that will be passing and how the depreciation will look. The first entry that will be passing is purchase of asset. Now, as we know that the asset procurement has happened on 1st of April, we'll mention the date and then we'll passing the journal entries as per the prescribed format what we have for journal entries. That means date, particular LF, debit amount and credit amount. We'll be passing here the journal entries for purchase of asset first. Now I've assumed that as there has been no vendor name that has been mentioned, that means there is a clear-cut case of procuring these assets at cash or bank. Hence, the entry that has been passed here is asset account debit to bank account. Now we'll further go ahead and see how this specific transaction will further continue in charging depreciation. Now at the rate of 10% under straight line method, that means we'll be further going and depreciating the asset at 10% flat out method for next 3 years. As I've mentioned earlier, that the procurement entry has to be passed only in the first year, whereas the depreciation charging and the profit and loss transferring entry will be common for the next 3 years. So we'll just pass on the entry for the first year and we'll have a replica of those two entries for the next 2 years as well. So if you can see, we have mentioned the entries here. First, depreciation has been charged. If you can see, I've mentioned the date as 31st March 2019. That means end of the financial year where the date has been mentioned, 31st March 2019, where the entries will be passed as follows. First, charging the depreciation account debit to the asset account. That is 1 lakh, as 10% on 10 lakh is 1 lakh every year. That means the depreciation amount is a flat method, flat depreciation amount, which will be 1 lakh rupees every year. Now for the next 2 years we'll be continuing these two entries itself. So first, depreciation amount has been charged to the asset. We'll now further transfer this specific depreciation to the profit and loss account. As we've already mentioned that this is an expense, hence profit and loss account will be debited and the depreciation account will be closed by crediting depreciation account. Hence, profit and loss account debit rupees 1 lakh to depreciation account rupees 1 lakh. Now, when you have passed this entry, that means you have closed down depreciation account for that specific year. So, now that we have closed down this specific thing, that means we have already mentioned, if you can see in the sheet, depreciation account for 18-19 has been closed. 18-19 is the financial year. That means April 2018 to March 2019, we have closed down the depreciation account by passing this specific entry. Now, what will be the treatment when it comes to balance sheet? I'll be showing you the balance sheet treatment after we have the accumulated depreciation for the next 3 years. However, that will be similar to preparation of depreciation of these entries, or probably depreciation entries for the next 2 years itself. So if for 1 year we have depreciation of rupees 1 lakh and it is fixed, that means for the next 3 years we'll have depreciation accumulated as 3 lakh. However, we need not show what is the depreciation value after 3 years. That means the question only states what is the depreciation value for the next 3 years has to be shown in terms of calculation. That we have already calculated 1 lakh for 1 year, so 3 lakhs for 3 years. As it is a straight line method, hence, if it would have been a written down value method, you would have to calculate every year's depreciation, because under written down value method, you have depreciation at the end of every financial year on the balance of the account or the asset that is in question. Now under this method, it is only on the fixed cost, that means the cost that has been procured when the asset was purchased. Hence, it is very easy for us to find out the depreciation under this method. So we have 3 lakhs of depreciation. Now we'll prepare the balance sheet and further evaluate how this depreciation account looks for this specific asset. Make sure, as this is not a provision for depreciation, hence we are not showing anything when it comes to preparation of balance sheet as a deduction or as a liability side asset thing. Or when it comes to provision for asset, if at all there would have been a provision here, what would be the effect will be shown in the next balance sheet here. Let's go ahead and prepare the first balance sheet. So now that we are preparing depreciation under the normal method, that means there is no provision for depreciation. In such case, if we can see the balance sheet has been prepared here. Let's find out how the balance sheet looks after charging depreciation. If you see, the asset value is 10 lakh, out of which depreciation has been subtracted rupees 1 lakh. This is only has to be followed if there is no provision for depreciation. What will happen if there is a provision for depreciation, you will get to know when we prepare the next balance sheet in the same sum itself. Now in this sum, if we have depreciation which is being subtracted under the normal method, this is how it will be shown. So when we talk about asset being charged or the depreciation being charged on the asset, if you can see, I have marked the asset account rupees 10 lakh as a box, and there is a decrease or probably reduction in the asset value, that is the depreciation. 1 lakh has been subtracted. So if you can see, 9 lakh is the output or probably the value of that specific asset at the end of that financial year. 18-19, the value of the asset that has been procured will be shown as 9 lakhs. Now what would happen if there was provision for depreciation here? We'll understand about this specific thing in the next sheet itself. Let's find that out and let's figure out what would happen if the same situation was under provision for depreciation, and this will be only restricted to balance sheet treatment. So if you can see, there is a provision for depreciation account that has been created in this scenario, whereby the provision for depreciation is shown on the liability side. Now if you see, if provision for depreciation has been shown on the liability side, similarly we have asset on the original cost. There is no reduction as compared to the previous sheet where we had asset value being decreased to 9 lakh from 10 lakhs. Here, in such a situation, if the provision for depreciation is created, the liability side will be affected and will have the balance of depreciation. However, the asset will still be on the original cost or on the natural cost itself. There will be no reduction in the value of asset. So this is the difference when we spoke about being asset charged as a normal charge or as a normal method, or if the provision for depreciation has been mentioned. Now, this asset was procured in the month of April. Supposingly, if this asset was procured in the month of October, then you would have charged depreciation at 10%. However, only for 6 months, as from October to March, you have 6 months here. Hence, the asset which has been used is only for 6 months, and hence the depreciation that has to be charged can be charged only for 6 months and not more than that, because depreciation is only charged when the asset is being used or is functionally being used for any of these business specific production usage. Hence, when we speak about depreciation charging, this is what we'll be doing. Either the method will change or the technicalities will change, however the entries will still remain the same. So this is what we learned today, and this is how the depreciation charging will be happening, or the accounting treatments will happen when it comes to depreciation for accounting transactions. Thank you for watching this video. Stay tuned to Ekeeda and keep subscribing to Ekeeda.